Hey everyone, welcome back to another video from Rookie Investor. In today's video, we'll talk about ETFs, what they are, their types, how to evaluate them, and how to invest in them. An ETF or exchange traded fund is a type of pooled investment security that you can buy or sell through a brokerage firm or stock exchange the same way like a regular stock. Typically, ETFs will track a particular index, sector, commodity, or other asset. In a previous video, we talked about the stock sectors and we have seen their respective ETFs. Basically, each sector has its own ETF. You have utilities ETF, materials ETF, information technology ETF, and so on. ETFs began in 1993 with a product commonly known by its ticker symbol SPI or Spiders, which became the highest volume ETF in history. Today, ETFs are estimated at $6.64 trillion with nearly 3,000 ETFs products traded on the US stock exchanges. You're probably wondering how an ETF works. Well, an ETF is bought and sold like a company's stock during the day when the stock exchanges are open. Just like a stock, an ETF has a ticker symbol and intraday price data can be easily obtained during the course of the trading day. For example, let's have a look at the popular stock market ETF, the Triple Qs. The Invesco Triple Qs ETF, formerly known as the Power Shares ETF, is an exchange-traded fund that tracks the Nasdaq's 100 index. The Triple Qs is considered to be one of the safer ETFs on the market and has received positive performance rankings from analysts. But let's have a look at it on trading view. ETFs are like stocks in essence. You can see their price, current trading price is at 275. The chart, it has been traded for over the past 20 years, and in general, you can do some technical analysis like the other stocks. However, unlike company stocks, the number of shares outstanding on an ETF can change daily because of its continuous creations of new shares and the redemption of existing shares. The ability of an ETF to issue and redeem shares on an ongoing basis keeps the market price of ETFs in line with their underlying securities. Although designed for individual investors, institutional investors play a key role in maintaining the liquidity and tracking integrity of the ETF through the purchase and sale of creation units, which are large blocks of ETF shares that can be exchanged for a basket of the underlying securities. When the price of the ETF deviates from the underlying asset's value, institutions utilize the arbitrage mechanism afforded by creation units to bring the ETF price back into line with the underlying asset value. Now that you know what an ETF is and how it works, let's talk about the advantages of purchasing an ETF. First, diversification. One ETF can give exposure to a group of equities, market segments, or styles. An ETF can track a broader range of stocks or even attempt to mimic the returns of a country or a group of countries. Think of Triple Qs, for example. It tracks the Nasdaq 100, or the ETFs that track an entire sector. Second, as we mentioned earlier, it trades like a stock. Although the ETF might give the holder the benefits of diversification, it has the trading liquidity of an equity. To be more specific, ETFs can be purchased on margin and sold short. They can trade at a price that is updated throughout the day, and they also allow you to manage risk by trading futures and options just like a stock. Because ETFs trade like a stock, you can quickly look up the approximate daily price change using its ticker symbol and compare it to its index sector or commodity like we did earlier with the Triple Qs. Third, lower fees. ETFs which are passively managed have much lower expense ratios compared to actively managed funds, which mutual funds tend to be. Third, lower fees. ETFs which are passively managed have much lower expense ratios compared to actively managed funds, which mutual funds tend to be, and we explained in detail mutual funds on a dedicated video we have on the mutual funds. 4. Limited capital gains tax. ETFs can be more tax efficient than mutual funds. As passively managed portfolios, ETFs tend to realize fewer capital gains than actively managed mutual funds. Fifth and last, lower discount or premium in price. There is a lower chance of ETF share prices being higher or lower than their actual value. ETFs trade throughout the day at a price close to the price of the underlying securities. So if the price is significantly higher or lower than the net asset value, arbitrage will bring the price back in line. Unlike closed-end index funds, ETFs trade based on supply and demand, and market makers will capture price discrepancy profits. Despite all their advantages, like any other investment type, they have disadvantages as well. First, trading fees. Although ETFs generally have lower costs compared to some other investments, such as mutual funds, they are not free. ETFs are traded on an exchange like a stock, so investors may have to pay a real or virtual broker to facilitate the trade. These fees typically range from $8 to $30, and they are paid every time the investor buys or sells shares in a fund. Second, operating expenses. Although most ETFs are passively managed, fund managers still incur expenses as part of normal business operations. These costs are reflected in the fund's expense ratio, which measures the percentage of an individual's investment that will be paid to fund each year. Third, low trading volume. When an ETF is actively managed, the higher number of trades within the fund may make the price more predictable. High trading volume can also make the ETF more liquid, which can be beneficial. However, most ETF trading volume is low, so the bid-ask spread may be wider, meaning investors might not get the price they expected. Investors can check an ETF average trading volume before purchasing the fund to see whether it will meet their needs. 4, which is pro and a con at the same time, is potentially less diversification. Many ETFs offer diversification because they contain hundreds or even thousands of securities within and across asset classes. But some ETFs are narrowly focused, concentrating on a particular sector of the market or a subset of an asset class. For instance, some funds focus on large cap or small cap stocks, a particular country, a specific industry, or a particular commodity. Fifth, capital gains distribution. Some ETFs own dividend-paying stocks, which generate cash. On other occasions, an ETF might sell an asset at a profit that results in capital gains. The fund manager can distribute this money into two ways: pass the cash to the investor or invest it to the ETF's underlying securities. Investors who receive cash but want to reinvest the money will need to buy more ETF shares, which create new fees. No matter how the ETF uses their cash or its sources, shareholders are responsible for paying taxes. Sixth and last, ETFs are designed to track indexes, sector commodities, or other assets. Many track a benchmarking index, which means the fund often won't outperform the underlying asset in the index. Investors who are looking to beat the market may choose to look on other products and services. Now that you know the good and the bad side of ETFs, let's proceed and have a brief look at the different types of ETFs in the market. Those are stock ETFs. Stock ETFs, also known as equity ETFs, track major stock market indexes such as the S&P 500, Dow Jones Industrial Average, and Nasdaq. Second, sector and industry ETFs. Sector and industry ETFs allow you to diversify your portfolio with stocks across multiple sectors and industries. For example, utilities, healthcare materials, and so on. Third, commodity ETFs. A commodity ETF tracks specific commodities. A commodity is a new material or agricultural product that can be bought and sold. Examples of commodity include gold, oil, coffee, wheat, rice, or livestock. When you purchase a commodity ETF, you do not own the underlying commodity itself. For example, if you buy a gold ETF, you are investing in gold, but you don't get a physical gold bar. Instead, you are purchasing a derivative contract that follows the price of gold. A derivative contract essentially allows you to invest in a commodity such as gold without having the actual asset. 4. Style ETFs. Style ETFs track a specific investment style or asset class size. An investment style is a set of guidelines used to build your investment portfolio. For example, it's not uncommon to see investment styles categorized by risk tolerance. 5. Bond ETFs. A bond ETF is a type of an ETF that invests in bonds. We talked in detail about bonds in a previous video, so if you have watched that, you would know all about them. Anyhow, a bond ETF is not subject to maturity because they trade on the stock market. This means you can buy and sell them throughout the day, just like stocks. Plus, you will be able to benefit from interest payments. 6. Inverse ETFs. Also known as short ETFs and bear ETFs, an inverse ETF seeks to capitalize from the declining price of stock or other investment. Quite popular at the moment as it's an easy way to sort the market. 7. Actively managed ETFs. Actively managed ETFs combine the benefits of a mutual fund with an exchange-traded fund. A mutual fund is almost identical to an ETF in that it's a fund that holds a basket of individual investments. Where the mutual fund starts to differ is that it's actively managed by a manager who makes decisions on how to invest the fund's money. 8. Dividend ETFs. Dividend ETFs are ETFs made up of dividend-paying stocks. Shares of a dividend stock come from companies that make regular quarterly payments to shareholders. These payments are taken from the company's profit. A dividend ETF not only offers you a regular income from dividends, but it also adds instant diversification to your portfolio. 9. Real estate ETFs. Real estate ETFs aim to track the performance of the real estate sector. When you purchase a real estate ETF, you don't actually own any physical real estate. Instead, real estate ETFs contain REITs. REIT stands for Real Estate Investment Trust. A REIT allows you to invest in the real estate without all the work typically involved with building and managing physical properties. In other words, you get the benefits of real estate investment without all the headaches. Number 10. Currency ETFs. Currency ETFs are built with a goal of providing you exposure to the foreign exchange market, Forex. A currency ETF allows you to diversify your portfolio by investing in currencies without the hassle of placing individual trades on the Forex market, which can be quite confusing for most. The last type of ETFs is the foreign market index ETFs. Foreign market index ETFs allows you to invest in international stock market indexes if you wish to further diversify your portfolio with companies outside the United States. Prior to concluding this video, I would like to mention 5 key factors to consider prior investing in an ETF. Those are: first, level of assets. To be considered a valuable investment choice, an ETF should have a minimum level of assets, a common threshold being at least 10 million. An ETF with assets below this threshold is likely to have a limited degree of investor interest. As within a stock, limited investor interest translates into poor liquidity and wide spreads. Second, trading activity. An investor needs to check if the ETF that is being considered trades in sufficient volume on a daily basis. Trading volume in the most popular ETFs runs into millions of shares daily. Some ETFs barely trade at all. Trading volume is an excellent indicator of liquidity regardless of the asset class. Generally speaking, the higher the trading volume for an ETF, the more liquid it is likely to be and the tighter is the bid-to-ask spread. These are especially important considerations when it is time to exit an ETF. Third, underlying index or asset. Consider the underlying index or asset class on which the ETF is based. From the point of view of diversification, it may be preferable to invest in an ETF that is based on a broad, widely followed index rather than an obscure index that has a narrow industry or geographical focus. Fourth, track and error. While most ETFs track their underlying index closely, some do not track them as closely as they should. All else being equal, an ETF with minimal tracking error is preferable to one with a greater degree of error. Fifth, market position. The first ETF issuer for a particular sector has a decent probability of getting more people to buy the shares. It is a good idea to avoid ETFs that are mere imitations of original ideas because they may not differentiate themselves from their rivals, and that means they don't attract enough investors to buy their assets, which means there's not going to be enough liquidity. ETFs are considered one of the best choice for beginner investors. Index funds are cheaper than their actively managed counterparts, and the reality is that most actively managed funds don't beat their benchmark index over time. To invest in an ETF, you need to open an account with a broker. All the brokers that allow you to buy and sell stocks will give you the possibility to buy and sell ETFs. Some of those brokers are E-Trade, TD Ameritrade, Fidelity, Charles Schwab, and Ally Invest. I hope that this video shed some light onto what ETFs are, their advantages and disadvantages, the types you will encounter in the market, plus the key factor to focus on prior investing in them. I will make more videos about investing, so make sure you hit the subscribe button, and of course, if you like the video, please smash the like button. It will mean a lot. Thank you for watching. See you in the next video.